Okay, so last class, we're talking about bonds and the price of bonds. And I gave two examples. One of them was a 5-year bond, and one was a 20-year bond. All right, everything else on the example was identical. So, and the point of that example was that the longer term bond was more sensitive to interest rate changes. So this graph, I'm going to set this up. We've got a bond that has a 10% coupon rate. That means it's going to have, and it's going to be a 20-year bond. One's going to be a 20-year bond and one's a 1-year bond. All right, so here's the 20-year bond down here. And it's got $100 coupons for 20 years. And the last year, the par value is paid back, right? So that's what the actual timeline looks like. The interest rate and the present value are what moves, what changes, if you will. Here's a 1-year bond. It gets one $100 payment, and then the principal is paid back at the same time. Again, works just the same, only it's a very short-term bond, right? So the math for this 1-year bond, the present value is going to be equal to the present value of the one cash flow that comes in 2 parts, which is $1,100. $1,000 of principal, $100 worth of interest. And we're just going to take the present value of it. Right? So that's the equation for that short-term bond. Notice it has one term. That's it. When we do the math for this long-term bond, the present value is going to be equal to the present value of these 20 different cash flows. The first one being 100. I'm going to divide that by 1 plus the interest rate raised to the first power. Second one is 100 divided by 1 plus r raised to the second power. So on and so forth, all the way out to 20 years. In the last year, we're going to have $1,100 come to us, $100 of interest, $1,000 worth of principal. We're going to divide that by 1 plus r raised to the 20th power. Now, the point of this graph, that green line represents all the possibilities of the price of the long-term 20-year bond, right? So all we're doing here is allowing the interest rate to change. And you'll see along the x-axis, interest rates are 5%, 10%, 15%, 20%. So a lot of different possibilities. What that green line represents is what we call a bond profile, right? And all we're doing is graphing the price of the bond, 1 point at 5%. So if we plugged in 5% for our interest rate in 20 terms, the price is going to be $1,768.62. Now, we can get Excel out to verify that. We should. Now, get us a new sheet so you don't have to look at call options. Okay, so I'm just going to put a list here. Here's the possible rates. And this is the present value. So at 5%, we got a 10%, we have 15%, and a possibility of 20%. All right, and then we're just going to calculate the present value for that bond. It's going to be equal the present value open up parentheses. I'm going to cell reference that 5%. I didn't see anything that said it was anything but annual compounding. So I'm going to do annual compounding first. Number of periods is 20 years. The payment payment annually is $100 a year. And then the par value is $1,000. And actually it looks like they did, since we couldn't reproduce it, we know the answer is actually 1768. And they are using semi-annual compounding. So I'm going to divide everything by 2. So the interest rate's divided by 2, and the number of periods is multiplied by 2. Now, sometimes they won't tell you the compounding, and you're going to have to kind of figure it out. Most bonds are semi-annual bonds, right? So in your homework and in your test, you have, they'll give you the interest rate, they'll be in annual terms, but the test will tell you whether it's going to be annually compounded. In other words, the coupons are going to come annually, or whether the coupons come semi-annually. Here, they weren't very careful about that. Oops. And I'm sorry, this wasn't a 20-year bond, it was a 30-year bond. And I bet you it is annual. And I just misread that, sorry. So I'm doing a 30-year bond. And there we go, we've reproduced it. There's my work. Again, I'm cell referencing the interest rate, and I'm gonna copy this down so I can see all the prices for this bond given the interest rate at 5%, 10%, 15, and 20. So I'm cell referencing that yield to maturity. The number of years to maturity is 30. The $100 is the annual coupon payment, the annuity, in other words, and then there's $1,000 par value, right? So that 1768 matches up on the graph with that 1768. When I copy this down, I'll have the prices for all those different interest rates. And you can tell that since we have a coupon of 10%, when the yield to maturity is 10%, we will have a par value bond. That's right there at that intersection. And then as the interest rates rise to 15%, which is above the coupon, we're going to be looking at discount securities. And those discount bonds are going to be less than 1,000. And here we got at 15%, that bond is going to be worth $671. And that would be a point right there on the green line. And then finally at 20%, you can see $502.11. And what I want you to notice is the fact that this green line has some curvature in it, right? That curvature comes from the fact that this math, it's not a line, right? It has got curvature, and we call it convexity. And it's coming from the fact we have a lot of exponents. They go out to raising it to the 20th power, and that's what's providing the actual curvature. Now, because it's curved like that, you can see that when interest rates go from 5 to 10%, look at the change. It's going to go from 1,000, and in order for me to not have to deal with minus signs, I'm going to turn all these around positive by putting a minus sign in front of that first one. When interest rates go from 5 to 10%, then the percentage change here, we're going to get 1,000 minus 1,700, all divided by 1,700. So that bond actually fell by 43% when it went from 5% interest in the market to 10%. Right? I've got this all set up to where I can copy that down. And what I want you to notice is that those rates of change, they're all negative, because as interest rates go up, prices fall, but notice they're falling at a slower rate, right? That's the point I want to make, that as interest rates rise, the sensitivity of the bond's price to changes in interest rates diminish. So in other words, as you get out at the end of this graph, it's becoming flatter. So at higher interest rates, bonds are less sensitive. At lower interest rates, like we have now, we actually have interest rates very close to 0%. You see it's very steep in this part of the graph, and the changes in those bond prices are far greater. They're far more sensitive to changes, right? As opposed to the blue line. The blue line is the 1-year graph. So this is a 1-year bond, matures in 1 year. It has one cash flow split up into a coupon payment of $100 and a principal payment of $1,000. And this is the math to it. And you can notice that first of all, we just have one exponent and it's a 1. Not all of these exponents like we had in the other problem. And when we graph that, it's going to be much flatter, right? So I'm going to put rates down again. Oops. And at 5%, 10%, 15%, and 20%. And the price, and I'm going to put a minus sign in front of it so I don't have to worry about the negative. The price at 5% for a 1-year bond with a coupon of $100 and a future value of $1,000 is far less, number one, than the 20-year bond was, right? Because you get far fewer coupons. It's still at a premium though, to par, right? So in other words, that interest rate was 5%, the coupon rate was 10%. Since the coupon rate is higher, it's a more valuable bond when you have a higher coupon rate, and so it's going to sell for a premium when interest rates fall. So when interest rates go down in the denominator, prices will rise, and it's going to rise above par. You can see at 10%, both of these bonds have the same price, and it's at par. It's right where they cross in that graph. You can also see that as interest rates rise on this 1-year security, the prices fall. Just like you would expect, interest rates go up, prices go down. All right, so now let's compute the percentage change as the interest rates rise. I'm just going to take our new rate price, old price, divided by our old price. And here, when we go from 5 to 10% interest, the bond's value falls at 4.5%, as opposed to that 20 bond, when interest rates go from 5 to 10%, it has a 43% decline in the value. That is a really big difference in the sensitivity of the bond. And you'll see though the same pattern. As interest rates rise, prices fall, but they fall at a lower and lower rate, even for the 1-year bond. It's just that these bonds are not as sensitive. And when you draw them, and you can see here, we've drawn that bond profile for that 1-year bond, where at 5% interest, the bond's value is $1,047.62. At 10% interest, it's right at par value, $1,000. At 15% interest, it would be $956.52. And then finally, when interest rates reach all the way to 20%, which is really high, it would be at $916.67. And so you get this flat, almost linear looking profile. This is not the equation of a line. but it is much closer to a line than this long-term bonds equation is. And so you can see where that curvature comes from. It's coming from time, the maturity, in other words. Does that make sense to everybody? So in today's world, let's try to apply that today. We have very low interest rates. Particularly the Federal Reserve Bank has lowered interest rates. A 3-month T-bill, a 3-month Treasury bill is at 0.14%. In decimals, that's 0.0014. It's very, very close to zero. And so in today's world, what is more sensitive? Well, first of all, if you think interest rates are going to go up from here, would you want to buy that 30-year bond, or would you want to buy the 1-year bond? Which one would you be more comfortable with?
30, right?
Say what? Is that Terry?
Yeah, if you thought they're going up, you'd want like a longer, like the 30-year, right?
So if they were going to go up, the 30-year is going to go down harder. Does that make sense? So if interest rates have gone up, you will want to purchase the short term as opposed to the long term. You're going to lose money on both, but it's going to be less on this short term 1-year rate. You're going to lose 4.5% versus 43%. As interest rates fall, you want the long term. Does that make sense to everybody? Now, banks have really large portfolios of bonds, and I imagine they were preparing themselves back in January for interest rates to rise. And so they were probably shortening the maturities of their bond portfolios. And then all of a sudden, boom, coronavirus. And immediately the Federal Reserve Bank acts and they push a ton of money into the economy and lower those interest rates, catching a lot of banks probably off guard. They would have preferred to have much longer maturities of their bond portfolios if they had known that this coronavirus was going to hit and the Fed was going to lower interest rates. Because when they lower interest rates, the prices that are going to rise, they're going to rise a lot more on the long term than on the short term. Does that make sense to everybody? Sort of, not really. We good? Okay, I got one thumbs up at least. One person got it. Okay. Okay, good. All right, so let's do one more problem as a yield to maturity question, and then we'll move on from it. So we've considered a bond with a 10% coupon, and it's annual. Its par value is $1,000. It's 15 years to maturity. So here's 15 years. It's paying annual coupons. They're going to be 10% of 1,000. And they're going to be annually paid 15 times. And then they're going to pay all the principal back at the maturity in a balloon form. And you look on Yahoo Finance, and this bond is going to be valued at $928.08. And that's what they've quoted for the price. Your question is, what's your yield to maturity? That is, what is the yield, your return that you're going to receive if you hold this all the way to the maturity date, right? So the math is going to look like this. $928.08 is the present value, the price today. That should be equal to the present value of all the future cash flows. First one is $100 divided by an interest rate that we don't know, we're gonna solve for, plus then the next one, which is $100. Raise the second top. We're gonna keep doing this all the way out to our very last cash flow, which is 1,100. We're gonna raise it to the 15th power. And we'll be solving for this interest rate, which is gonna be kind of nasty if we had to do that by hand, algebraically. We're gonna do it in Excel. All right, I'm just gonna hit equal rate. The number of periods was 15, and that's in annual form, so 15 years. The payment is $100 per year. So everything's being plugged in annual terms. The present value is the price today, and that is minus. We're gonna have to pay out. We're gonna receive in the $100 payments, but we're gonna have to pay out the price today. That's $928.08. And then the future value should also be positive because we're going to get the coupons in and then we're going to get the principal, and that future value is the principal. So that's going to be an inflow and it should have a positive sign. Close up the parentheses and our interest rate. After we get enough decimals in there, it looks like it's 11% even. And that's an annual rate that we're looking at because everything we plugged into Excel was in annual terms. All right, any questions? What if we were to do this semi-annually? Well, this timeline changes. If it were semi-annual, first off, we'd have 36-month periods to get a coupon, but the coupon would be 10% of 1,000 divided by 2 payments per year, which is $50 a piece. So you'd be receiving $50 coupons 30 times. In other words, every 6 months. And then you'd still get your principal back at the 30th time period. In Excel, all we have to do is change up our inputs. So that number of periods, instead of 15, it's 15 times 2. That coupon payment, instead of being 100, is going to be 100 divided by 2. And then that's the only thing that's time sensitive. Everything else is in lump sum form. And so we can just hit enter. And what we're looking at right there is about 5.5% interest, but that's over a 6-month period. So if you converted it into an annual percentage rate, that's going to be equal to that times 2. So I should make sure that I correct my math here. This interest rate will be divided by 2, and instead of having 15 periods, you're going to have 30. And for instance, this first period is actually your 1/2 of a year, that's N times M, which is 2, and that coincides with 1. All right, so in other words, our interest rate that we need then to get this to all equal out is just slightly less than 11%. It's 10.99%, not 11 even. Any questions about that? All good? Good, thank you. All right, so this is another one just like it. It's with semi-annual coupons. I notice here that in this problem that it's selling for $1197.93. That's at a premium. So we've got a bond with a 10% coupon rate, same as we had before. semi-annual coupons, which means that they're going to still be $50 coupons, still got a face value of $1,000, and it's 20 years to maturity. Okay, so since it's 20 years to maturity, that's 40 semi-annual periods. All right, and so we'll be getting 40 coupons and then $1,000 par value at the maturity date. The math will change here again. We'll have $50 coupons and then $1,000 par. And then the price has changed. It's a premium. It was $1197.93. So basically the same question with just a little bit different parameters in it. So I'm just going to hit equal rate. The number of periods now is 40. The payment is $50 per 6 months. The price today is $97.93. And the future value is a lump sum of $1,000. Now the rate that we're going to be getting here is going to be a semi-annual rate. Now since we're dealing with a premium bond, its price is over $1,000. That means that the coupon rate, which is 10%, must be higher than the going market value for the going market yield to maturity. So we're expecting an interest rate that's going to be lower than 11% here, right? Or actually lower than 10%. So when I hit enter, and something's wrong here, I got 40 periods, payments 50. Oh, I got too many ones here. 1197.06 there. All right. So 4%, almost even. That's a semi-annual period. So to get my APR, I have to multiply it by 2. So in other words, now, since we're looking at a premium bond, we know that market interest rate, that yield to maturity must be lower than 10%. And we get right at 8%, which is a good indication that we got it right. Any questions? Good? Okay. All right. Now what I'm just going to do is talk about different, what I'd call institutional detail, right? What we've just learned to do is price a bond that I'd call vanilla or plain, right? It's the way a lot of bonds work. It's the way all treasury notes and bonds work. So this is the most common form, but it's not the only form. So we're going to talk about some differences in some types of bonds so that you at least understand what's going on with them. The first thing you need to know is the difference between debt and equity, which I think we've talked about. Bonds are debt. That's very important to understand. It is not, when you buy a bond, you are not buying ownership in the company. You are a creditor, right? Two very different things. So you're a creditor, you will not have any voting rights, right? So you will have no say in how the company is run. The interest that the company pays is considered a cost of doing business and makes it tax deductible, meaning that on the business that is issuing the bond, they are deducting the interest off their income statement before they compute their taxes. This makes debt inherently a cheaper form of capital than equity. Because when you issue equity, dividends are the cash flow, and they are not tax deductible. They come after taxes are computed. So it makes debt cheaper inherently, all else held constant. Excess debt can lead to financial distress. So in other words, those that have excess debt, some companies, Chesapeake, for instance, is a company I own. They're probably going to go bankrupt. I bet this week, next week. They're an American fracker. They have too high of debt to equity ratio, a too high of debt to asset ratio. They've had that for a long time. It's been years now. They've been over levered, and their bondholders, if they're not paid, can push Chesapeake into bankruptcy, right? So excess debt can cause bankruptcy. Equity is ownership. It's an interest in the profits that occur. However, the residual claimants, the debt holders, have to be paid their interest and principal before the equity holders can get anything. So they are inferior, they're junior to the debt holders. Common stockholders, they vote for the board of directors, and also other issues that might come up. Dividends, as I said, are not a cost of doing business, and so they are not tax deductible for the firm issuing the equity. Dividends are not a liability. They do not have to be paid. And stockholders have no legal recourse if a company doesn't pay dividends. And all equity firms cannot be forced into bankruptcy. So if it's an all equity firm, there's quite a few tech companies that are all equity. Nobody will lend to them. No bank will lend to them, and they can't issue debt. So they have to get angel investors. Those angel investors, like on Shark Tank, for instance, oftentimes are making some sort of equity deal with them. All right, so here's some terms. One is called the bond indenture. It's basically a legal contract, and it outlines all the basic terms of the bonds. So all the things that we've talked about, the coupon, the maturity dates, the par values, those are all clearly defined in what we call the indenture. So it's the basic terms of the bond, the total amount of bonds that are issued. We've been working with one single bond at a time, but in reality, these companies will issue hundreds of millions of dollars in some cases of bonds, and they just increment them up, chop them up into $1,000 par values, right? So it'll tell you the total amount issued, which tells you a lot about how they're changing their capital structure. In other words, how much debt they're taking on. A description of property, if there's going to be any kind of security used against the bond. So these bonds work just like a loan. If you got a car loan, your car is used as collateral, as security. If you don't pay your payments, the bank comes and looks for that car to repossess it. Same with a house, right? Bonds can have security pledged against them. And so if there is security pledged, collateral pledged, it will be identified in the bond indenture, exactly what it is, where it's at, where you can find it in case the company defaults on their debt. They can find where the collateral is. There's also sinking fund provisions. Sinking funds are just basically a fund in which a company pays into early to make sure that their payments are actually paid in full early. Sinking funds are good and makes the investor feel more secure that those obligations are going to be paid to them. Then there's something called call provisions. And a call provision, you'll usually hear it called a callable bond. And a callable bond basically means the call option is the right to buy. And the right to buy can be given to the issuer, or it could be given to a bond holder, right? But in the case of these bonds, when you hear the term callable bond, the call has been implanted in the bond and has been the right to buy it back has been given to the issuer, right? So callable bonds are basically a mechanism. If there's a call option on the bond, it's a mechanism for the company to be able to refinance their debt. It gives them this ability to buy back their debt at a specific strike price. And then what they'll do is turn around and reissue that debt. Usually the whole purpose is at a lower interest rate. So companies that have debt right now that is callable, they may be exercising their call options right now. And that means if you're the holder of that bond, if you purchased it, there'll be a price called the strike price in the indenture in which you are forced to sell the bond back to the company at that strike price. And that can be very different than the market price, right? Any questions about callable bonds? All right, and then the last item on this page is going to be about protective covenants. And what a covenant is, it's a promise. And there'll be protective covenants in the indenture that are basically promises that the issuer is making to the bondholders. They can be things like will not exceed a certain debt to asset ratio. So in other words, if you're looking at buying a bond from company ABC and they actually have a protective covenant and they're saying that we won't have a debt to asset ratio more than 75%, they're promising to you as a potential bondholder that they will not get more levered above 75%. Because if they did, they put you at risk, because these bonds are listed in a hierarchy, and more debt means more obligation. And more obligation means that the bondholder is at risk. And so they'll place protected covenants in there, like maybe caps on executive salary. Again, executive salary comes out before stockholders get their money, and oftentimes bondholders get their cash flows. And so protected covenants are there to protect the bondholders and to protect the obligations of cash flows that are coming to them. All right, so each one of these items will have an impact on risk to the investor. And when they have an impact on risk, that investor is going to want a higher return. So more risk comes greater return. Less risk comes less return. Each one of these items, which I call bells or whistles, actually has an impact on risk and return. So let's take, like, for instance, security, property security, collateral. The more collateral pledged, the less risky it is to the investor. Because if the bondholder were to actually default, the bondholder can go out and actually find the collateral and repossess it. Now, hopefully it's in the same condition. They call that perfecting the capital, the collateral, but hopefully it's in the same condition, and then they can resell it. And so they get something back rather than nothing. And so with more security comes less risk, and less risk means less return. Then you've got sinking funds. Sinking funds also are good security for that bondholder. So if there's a sinking fund involved and there are funds that the company is depositing into this fund, then that means that they're going to be good for at least a couple of periods to make their payments, their obligations. And so with a sinking fund means you take on less risk. With less risk, as a bondholder, you're going to require less return. Call provisions are another story, though. Call provisions, when they call it a callable bond, has been issued. The call option has been issued to the company, the entity that's actually going to be issuing the bond. And the problem with callable bonds for the investor is that you are forced to sell back the bond to the company at a specific strike price, which may be below, maybe above, maybe at the market price. But the bottom line is, typically a company is doing this. They'll exercise their call option when interest rates are falling. So when interest rates are falling and they force me to sell my bond back to them, that means I get a lump sum back and I go out and reinvest at a lower interest rate. And so I'm missing out on interest payments. So as a bondholder, call provisions increase the risk and therefore increase the return I'm going to require. Right? Protective covenants decrease risk, therefore decrease return. All right, any questions about that? All good? Okay, so here's some more terms. There are two forms of bonds. One is called, and these are very general. One is registered with the SEC, where there is a name of a person who has purchased that bond. And so the SEC would have your name if you bought a bond and know where the coupon payments and the principal par value have to be distributed to. A bearer form is where there is no registration, and instead you receive a coupon book as a owner of the bond. And in this coupon book, you tear off the coupons and you have to write your name on it, put your address, you send it in the mail to the company. The company then replies back with your coupon. So you lose the coupon book, you lose all your coupons. Right? So whoever bears the coupon is the owner of the bond. And so they're far more risky, right? In the US, we only have registered bonds unless they are 270 days or less in maturity. Now, security that we talked about comes in a lot of different forms. And I sometimes generically call security collateral, and that's not really the right way to talk about it. Security has several different types of security. One is collateral. That means that there is a financial security, like a checking deposit or a CD, something financial that is securing the bond. A mortgage security is where the bond is secured by real property, land, building, something of that sort. And then you hear this term debenture, and debenture means it's unsecured. There is no security. They are also typically junior to all of those bonds that do have security. And then finally, we have these terms, notes. Notes are unsecured debt, and they have maturities of less than 10 years, right? So when we're talking about corporate bonds, it's typically 1 to 10 years you call it a note. When it's less than 1 year, you call it commercial paper. And when it's more than 10 years, you call it a commercial bond. When it's a government that's issuing the debt, you call it a bill if it's less than 1 year. You call it a note if it is between 1 and 10 years, and you call it a bond if it's more than 10 years. All right, so seniority has everything to do with where the bond is in relationship to the top of the balance sheet. The higher up that balance sheet, the more pressing the obligation is to the bondholder. So if you have a senior bond, the characteristics of a senior bond is it might have security, right? So if there's security pledged against the bond, you can actually go and get that collateral, that security, and repossess it. And you have something for your money if they don't pay. So senior bonds tend to have collateral. They also tend to be older. In other words, they were issued earlier. So the more junior bonds will be more unsecured, and they'll also have been issued later. So in other words, with less seniority, you're further down the ladder as far as are you going to get your money if they go bankrupt, right? And so we got some companies going bankrupt, it looks like, Chesapeake being one of them. And so, of course, the bondholders are really going through their indentures right now, looking to see just what it is they bought, you know. And that this isn't really the time to be doing that. You should be doing that up front when you're buying it, but it's always the case. People are just willy-nilly buying the bonds. And then when bad things happen, when distress occurs, when there's a real chance of bankruptcy, that's when you get the legal documents out and you start looking at the fine print about what it is that they owe you, what it is in the contracts specifically. And so I'm sure there's a lot of particularly oil companies out there, fracking companies, in which the bondholders are looking to see where they're at on the ladder, if you will. All right, so I've got some questions here. So you guys can turn on your mics and answer these questions for me. So a coupon rate, when it's originally assigned to a bond, is assigned at when it's being issued and is exactly equal to the yield to maturity when it's issued. So it's a par value bond when they issue it. Anything that causes a bond to have greater risk will have greater return, right? So if a bond, all else held constant, has secured debt as opposed to being a debenture, would that secured debt have a higher coupon assigned or a lower coupon assigned? Anybody? Alvin, Terry, I see your faces. If you had secured debt, in other words, there's some collateral pledged, is that going to be risky?
It'd be a lower return, but I'm trying to, I don't know, is that the same thing as a lower coupon rate, I guess? I don't know.
Absolutely. At the initial issuing, the coupon and the return, the yield to maturity, in other words, are equal. All right, so a bond that has more risk will have a higher coupon assigned. A bond with less risk, all else held constant, will have a lower coupon assigned. So secured debt is less risky, therefore lower coupon rates are typically assigned, all else held constant. With subordinate debt, that subordinate debenture has no security pledged versus senior debt, which one's going to have the higher coupon? All else held constant.
Subordinate.
Absolutely. Subordinate debt will have a higher coupon. What about a bond with a sinking fund versus one without? Which one will have higher coupons? Sinking funds make it more sure you're going to get your interest and principal in time, you know, because they're prepaying into the sinking fund early. And with that sinking fund, you're going to have a lower coupon. Without a sinking fund, the coupon's going to be higher. A callable bond, you're going to have a higher coupon because there's this risk that the company calls back the bond and wants to refinance at a specific strike price. That puts the bondholder at risk of losing some interest. And so a callable bond will have a higher coupon versus a non-callable bond. Right? Any questions about those? About risk and return there? Okay. Now grading. Grading for a bond is very much like grading a student, right? So you got three major grading agencies. One of them is called Moody. You might have heard of them. Another one is called Standard & Poor's, and that's what we have up here looking at those grades. There's also another called Fitch's. It's a third grading agency. Every bond has to be graded by at least two of these, and they get put in a separate type of group if they do not get graded. And only certain types of investors can buy those. But my grades are AAA. ratings, and this basically means whether it's Moody's or Standard & Poor's, it means there's just a very high capacity of payment, very, very low possibility of default. And that's the same for AA, but a little less. Capacity to pay is very strong. It's just not excellent, in other words. Then you have medium grade. These are A's and triple B's. And these are capacity to pay is very strong, but it's more susceptible if there are economic changes. And so they're a little bit more risky. Everything you see on this particular slide is what we call investment grade quality. Banks are not allowed to buy anything other than investment grade quality bonds, right? You and I, whatever, but banks can only have triple B or better in their portfolios. Now the next page has all of the what we call speculative bonds. You might have also heard them called junk. Junk bonds just mean that they're lower grade, and they start with double B, and they go all the way down to a D grade. So low grade is double B or Moody's, or sorry, B little a, the actual notation. But it's considered possible that the capacity to pay will degenerate, it will degrade. There's a lot of bonds probably right now that are in that kind of group that are degrading right now. Their capacity to pay is being questioned. Hence all of our government programs to help companies make payroll and things like that. And then the very low grade, the C's, these are sometimes what we call income bonds. No bond ever starts out at C grade. It deteriorates to a C and never starts out that way. Most bonds start out at AAA, AA, maybe triple B, but they degrade down into the junk section. And what an income bond is, never does a bond start out as an income bond. This is renegotiated. So in other words, at some point, a company might find themselves in distress and unable to pay the coupons. So bondholders will table with them and negotiate and say they don't want to lose their cash flows. But if the company takes bankruptcy, it's very possible the bondholders lose everything going forward. We don't want to do that. Everybody has the incentive to come to the table and renegotiate. And one of the issues that they might renegotiate is the company can say, let's turn your what once was a AAA rated bond, income bond, lower the grade down to C, but bond only pays the coupons if the company has income. All right, so if they don't have income, a lot of companies don't have income. If they had income bonds, they would not have to make the coupon payments and they would not be paying default. Right, so, but I want to make certain everybody understands that income bonds, no bond starts out, it deteriorates in that situation. And in some cases, even D-rating bonds, that means that they're in default of some sort and of principal or interest not been paid on time. So that's where you get D rating. So if they miss a payment or if they're late on a payment, that will push them down into the D range. Okay, any questions? What we priced were treasury securities, treasuries, notes, and bonds. So all the math that we did was for treasury securities. Treasury securities are issued by our United States Treasury, that's the federal government. And there are three kinds of treasury securities. That's T-bills, T-notes, and T-bonds. Like I said earlier, bills are 1 year or less. Notes are 1 to 10 years. Bonds are 10 or more years. And in the United States, the longest term issue is for 30 years. The British, they have their government securities are, some of them are perpetual, and they call them consols. So they have infinite maturity dates. We don't have any of those here in the US issued by our government. the difference between a bill is 1 year or less, but it is structured as a bullet. So all those notes that we actually just priced are structured in balloon form. They have a string of coupon payments with a balloon principal payment at the end. You can imagine walking around with a string with a balloon off of it. The coupons are the annuity string, and then the principal is a lump sum amount that is at the end of that string. A T-bill is slightly different. It does not, first of all, it has 1 year to maturity or less. They come in the form of 2-week bills, 1-month bills, 3-month bills, 6-month bills, and 1 year bills. But what makes it unique is not only that they're very short term, they do not pay coupon interest. So they are a 0 coupon bond. So a T-bill is a 0 coupon security. All right, that means that the only payment is the principal. And that's why we call it a bullet. There's no string attached, no interest attached. It's just one single bullet, one single payment of principal. So that means that when you find the present value of a T-bill, it will always be at a discount from par. Always. All right, and because of that, we call them pure discount securities, meaning the only way that you actually make money on a T-bill is through what is actually capital gains. The fact that you're buying it for less than you're getting at the maturity date. And so it's actually technically a capital gain that you're earning, not interest income. All right, any questions about those? Easy enough. All right, then there's municipal securities. These are issued by states. It can be issued by parishes, school boards, any other government authority that has authority to tax. And municipal securities are debt issued by states and local governments. They are varying degrees of risk, default risk that is, and it's very similar to the grading of corporate bonds in that you can see a municipal bond can be graded as AAA down to D. The special thing about the municipal bonds is that their interest to the bond holder is tax exempt. You don't pay interest, you don't pay any tax, federal tax, on the interest that you receive, right? So that gives us a little problem to work. Municipal bonds are unique, and we have to kind of consider them a little bit differently. Let's say that you have a taxable bond, a corporate bond, for instance, issued by AT&T, and it has a yield to maturity today of 8%. So the tax, I'm going to say R, and this is taxable, and this is before tax rate of return, something that you would see quoted in the Wall Street Journal. And this is at 8% for the taxable. Before tax rate of return on your municipal bond is 6%. Very different. That's a 2% difference, right? But this municipal, this muni, is not taxed. And it's not taxed for certain at the federal level. And it depends on what state you live on for the state level, right? But your decision on which one of these bonds to actually purchase is contingent on your marginal tax bracket, right? So we talked about that back in chapter 2, marginal taxes. So let's say that your tax bracket is 30%, your marginal tax bracket is 30%. Which bond do you prefer? Okay, well, your before tax rate of return for this muni is the same thing as your after tax rate of return because you don't pay tax, 6%. We have to adjust this taxable bond because it has not been taxed yet, and it will be. So the after-tax rate of return is going to be equal to your before-tax rate of return times 1 minus your marginal tax rate. All right, so this 1 minus 30% leaves us with 70% of that return we get to keep. 30% of the return goes to the government. So that after-tax return on that taxable bond is going to be 8% times 1 minus 30%. And that turns out to be 5.6%. So we're going to compare this after-tax return on the muni, or sorry, the taxable is 5.6%, the muni's at 6%. I'm going to pick it. Does that make sense to everybody? And that's given a 30% tax rate. Now, as that tax rate goes up, say to 50%, it just gets even more pronounced. If you have a marginal tax rate of 50%, you're only going to get to keep 4% of that before tax return. And so you can see here, the higher the tax bracket you're in, the more likely you're going to choose the muni. So municipal bonds are oftentimes purchased by rich people who have high tax rates, right? And this is a way to avoid some tax. All right, any questions about that? Easy enough? In any investment that you make, always consider your after-tax rate of return, not your before tax. It's your after-tax rate of return on the investment that matters, right? And that's going to depend upon your tax bracket. Now, the second part of the problem says, at what tax rate would you be indifferent between these two investments? So the word indifferent, you should think of as equal, all right? They're equal. And your after-tax rate on your muni would be equal to your after-tax rate on your taxable bond. Okay, so your muni's after-tax rate is going to be 6%, same as your before. Your taxable bond is going to be your before tax rate times 1 minus your marginal tax rate. We know that our before rate of return on the taxable is 8%. So what we have is two choices, and we're going to have to solve for our tax rate here to see what makes us indifferent between the two. So I'm going to solve for T. And that's going to be 6% divided by 8%, and that's going to give me 1 minus T. Minus T is going to be equal to 6% over 8%, that's minus 1. Now I'm going to multiply through by minus 1. So I'll go over here. Your tax rate is going to be equal to 1 minus 6% over 8%. And that turns out to be 25%. That means if your tax rate is below 25%, marginal tax rate is below 25%, you're going to choose the taxable bond. And if your tax rate is above 25%, you're going to choose the muni. You're going to have a higher after-tax rate. Right at 25%, you're indifferent. You don't care. They're the same. All right, any questions? Well, I feel tuckered out. I think I'm dehydrated. So I'm going to call it off for today and give you guys a little break and let my husband come in and teach his class. And I'm going to try to get hydrated. I'm at 10,000 feet and I feel dizzy. I've talked too much already today. Is there any questions? No. Okay, all right. Well, I'll see you guys on Tuesday, and you guys got homework that's up on Connect. it's setting up there for you to work, and you can work as many of them as you want. I think you're really ready to work all of Chapter 7 problems for sure. And Chapter 7, I think I'm going to probably just cut it off. I'll talk about some floating rate bonds next time. But other than that, I think pretty much be done with it and move on to stocks, right? See you later.
Bye.
Bye.